Okay, so picture this. A cruise ship sails with empty cabins on purpose, but the company still completely crushes earnings and takes in an all-time record near $9 billion in customer deposits. Welcome to Earnings Unscripted. Today is June 23rd, 2026, and we are unpacking Carnival's second quarter. Ticker CCL. And Miro, it is kind of a wild shift in strategy from the whole pandemic race to the bottom, isn't it?
It is. It is pretty bold. They basically chose ticket integrity over full ships in Europe. And look, just a quick reminder for anyone listening, we are just two friends sharing personal opinions here, so this is definitely not financial advice. But yeah, Carnival's approach is fascinating right now. They brought in $6.66 billion in revenue, up nicely from 6.16 last quarter. So they are definitely squeezing more yield out of fewer people.
Right. And it just completely flowed to the bottom line. Earnings came in at 41 cents a share adjusted, which is, honestly, that is up massively from 19 cents last quarter. They handily beat expectations. Operating margin hit 12.8% too, so they are clearly making money, but the market reaction was kind of a mess today.
It really was. Shares gapped down sharply pre-market, opening at $27.40. They did establish a pretty steady uptrend intraday to close at $28.72. But the primary earnings reaction was still a drop of almost 5% against the prior day. Investors are clearly looking past the top-line beat and worrying about the macro outlook.
Exactly, because the CEO actually called their European bookings in March a, quote, cardiac arrest for a little while, which is just such a vivid way to describe people getting spooked by Middle East volatility and holding off on flights.
Yeah, but that is exactly why their private island strategy is in absolute overdrive right now. If consumers are hesitant to fly across the world, Carnival is pivoting hard to these massive domestic drive-to-dock resorts in the Bahamas. Celebration Key is ramping up to handle over 13,000 guests a day.
With the world's largest water slide sandcastle. I love that detail. They're just building a completely owned, geopolitically safe bubble. But here's the thing that really stood out. How do they keep margins that high when they're literally letting cabins go empty in Europe and paying massive supply chain premiums?
That's the crucial piece. Adjusted cruise costs, excluding fuel, were essentially flat year over year. In this economy, to pull that off without destroying the guest experience means someone is finding pure operational leverage in the background.
All right, let's get into the details on that, because I know you dug into exactly how they're finding these micro efficiencies.
They are literally counting forklifts on the loading dock. It is peak operational obsession. The CFO, David Bernstein, actually gave this exact example. He said, quote, when you go from 14 to 13 forklifts and you can make a change on multiple ships, it saves hundreds of thousands in a year.
That is incredible. You picture this multi-billion-dollar leisure giant, and they're basically using stopwatches on heavy machinery, just turning over the sofa cushions.
You have to when the supply chains are this unpredictable. Fuel prices jumped a brutal 30% year over year, so they found ways to drop actual fuel consumption per passenger day by about 5.5%. But the really fascinating part is how this ties back to those empty cabins.
Right, the Europe situation, because historically the cruise industry rule is you never sail with empty rooms. You slash the ticket price to get bodies on board because you need them in the casino. You need them buying drinks.
Exactly, the onboard spend. It is usually the highest margin revenue they have. And the CEO, Josh Weinstein, he admitted they are giving some of that up. He explicitly said they are deliberately utilizing much of that occupancy advantage to prioritize price integrity.
Okay, so they're actively retraining the customer. They are saying the days of the last-minute fire sale are over, even if it costs them some high-margin drink packages in the short term.
Yes, which is a massive structural shift for them. I mean, to pull off an EPS beat while literally leaving money on the table in Europe shows real confidence. Though I should mention, the math is getting a little help from the accounting department.
Ah, there's the other shoe dropping. What did you find in the filings?
Well, quietly, back in late 2025, they changed the depreciation schedule. They increased the estimated useful life of their ships to 35 years, and they slashed the residual value on their newer LNG ships down to just 5%.
Wait, they extended the timeline so the expense gets spread out over more years?
Mechanically, yes. It instantly lowers depreciation expense on the current income statement. Bernstein even flagged it on the call as an 8-cent per share operational favorability.
8 cents? Wait, out of the 41 cents in adjusted earnings, that's roughly 20% of the profit right there, just from changing a spreadsheet assumption.
Right. Now, ships probably do last 35 years with their new refit programs, so it's defensible. But if you strip out that 8-cent paper bump, the margins are still great. They just aren't quite as miraculous as the headline looks.
That's the exact context you absolutely miss if you only read the press release. They're doing real, granular work to save money, but the accounting is definitely doing some heavy lifting, too. Which really makes you wonder how bulletproof the rest of the year actually looks for them.
Exactly. And that is where the guidance gets, well, a bit defensive, actually. Because for the full year, they revised yield growth down to about 1.75%. They are squarely blaming the Middle East and that whole Europe booking freeze we talked about for that.
Right, but they are playing defense really well, right? I mean, the CFO pointed out that this yield drop is being perfectly offset by the exact cost cuts we just went over. Basically saying, sure, revenues might slip a point, but we'll just, cut expenses by a point to match it.
I mean, true. But you can only count the dockside forklifts so many times before you just need people to actually buy the European tickets. Mm-hmm. That said, looking at Q3 specifically, they are still guiding for roughly $2.88 billion in adjusted EBITDA. So the core cash machine is definitely not broken.
And you know what is really telling about their mindset right now? Josh Weinstein had this great line on the call. Someone was asking about adding industry capacity, and he said, quote, "Give me two options. One is no growth, and the other is 27. I will take the no growth."
Yeah, that is, you really do not hear a public CEO say that very often.
Never. But I think it just shows they're finally done building ships purely for the sake of market share. They're focused on generating cash, opportunistically buying back stock, and just leaning heavily into those private islands.
Yeah, which honestly is the right play. If they can execute Celebration Key without any massive logistical snags, and they already have something like 93% of their business on the books for the rest of the year, they have a serious moat. The real wild card going forward is just whether geopolitics drags down travel demand faster than they can tweak the accounting.
Right. So keep your fingers crossed and keep turning down the thermostat on the ships. I think that's the perfect place to leave it for today.
Definitely. Thanks for listening, everyone.
Catch you next time. If you want these earnings chats to just show up in your feed, feel free to follow the show. We're actually putting this project together using AI tools, like having a model compile the initial filing data, just to explore how humans and tech can team up on audio. We'd really love your feedback or any ticker requests, so email us at earningsunscripted@datamadness.ca or grab the X link right in the show notes. Talk to you soon.
See you next time.